Hey traders, welcome to our Sunday weekly show. Great to see everybody. Hope everyone's enjoyed their weekend. Oh, I need to turn myself off. Our Sunday Hang on. Muting myself. All right. Hit that mute button. I don't even know where I'm playing. There we go. So great to see everybody. And of course, this show is about your questions. We're going to be tackling some of the major points from the notes. I do want to pop those onto the screen here real quick. Look, we could talk about a lot of technicals. We could talk about the way the markets broke down last week. In fact, we likely will touch on that. But really, this week is all about Wednesday and that FOMC statement. We're going to see a very likely half-point hike coming up. And the press conference is really going to be where all the fireworks are, because this is going to set us up for July, expecting another half-point hike. Say so the Fed Fund futures. We're looking at another quarter at least in September. So we've got a lot to be dealing with as we not only get the half-point hike this week, but prepare for what's coming. And if you take a look, and I want to show you all the bond and the VIX. Now, on the 31st of May, and you can check this out at the Simpler Trading YouTube channel, we talked about the bond and VIX in a free update. And the idea, and this is sort of the analogy that I'm using to explain some of the shenanigans that happened with bonds. This will not be the last time, but it was a little surprising that this happened so soon within the tightening cycle, with Fed Fund futures and inflation data saying it was nearly impossible that the Federal Reserve could tap the brakes on rate hikes. This was the second time this year that bonds and investors and traders made a really bad bet, so to speak. The first time was Ukraine. There was a narrative that, the Fed can't hike rates because of what was happening in the Ukraine. That ended up being very, very incorrect. And then the most recently, we saw something again where bonds, whether that be the 10-year or the 30, every now and then, bond traders are a smart bunch, don't get me wrong, but they will play a game of chicken with the Federal Reserve, which is to say they'll rally bonds in the movement higher in the bond futures. That includes movement higher in IEF, TLT, ZN, ZB. That move higher is actually rates coming down. And that's a bet. That's sort of to twist the arm of the Federal Reserve to say, look, we think you've got monetary policy all wrong, or we think we can front run what you're going to do. And they tried to front run it. The problem is bond traders, again, a little different a bunch than, say, equity traders. You've really got to be a little bit more inside baseball to be a bond trader. One of my mentors, early mentors, was a bond trader, probably one of the sharpest traders I've ever met. And there's a whole other, it's just such a layered, nuanced approach to the market when you're a bond trader. Equity traders, not so much. And I like trading equity, so I'm throwing myself in there. I consider myself an equity trader than a specialist in bonds, which I'm not. But what happened is equity traders said, sure, we'll go along for the ride. And we saw this move. And all of a sudden, what was the talk? Oh, the bottom's in and the Federal Reserve's going to change monetary policy. And we better buy now. We just waited. And then we waited until what? We got some PCE data. We got some inflation data. We got some CPI data. And this just reminded everybody that central banks around the world, including the FOMC, just don't have a handle on inflation yet, which means more rate hikes, which means equities are going to hate this. Now, what I've been reiterating is, gang, yes, every now and then there may be a V or U bottom or a W bottom, but these are rare and lower probability as opposed to simply the continuation move, which is exactly what we're seeing in bonds, which is exactly what we're seeing in the indices. By the way, that's exactly what we're seeing in crude oil. So I want to show you all that the continuation, this is Charles Dow 101. His theory was give the prevailing trend, even if it's taken a break, give the prevailing trend the benefit of doubt. And that's the opposite of what a lot of traders tend to do. So yes, there are exceptions, but remember, your probability is just to note the trend that preceded the chop and expect continuation. So that's the foundation for everything that we've been talking about in trading. Now, I will say the way in which that move at the end of the last couple of weeks of May happened was really frustrating because, wow, traders got way ahead of themselves, rallied the trend, disrupted, I should say, rallied within the downtrend, disrupted the downtrend, but you can see what happened. And this is how we're going to be, basically waking up to the Sunday open. Take a look at the S&P here. We're getting a little bit, there's a gap right there. So we gap down today. Now, this brings me to one more point, and then we're going to jump into the questions. Don't fade Fridays. Don't fade closes, period, but don't fade Fridays. What does that mean? Well, if you're thinking about the sell-off on Friday and thinking, oh, we've hit a floor and I'm going to buy that. Even the same applies to moves to the upside. Oh, this is the ceiling, we'll short that or buy puts, or here's the floor, we'll buy that or buy calls. Do not do that. Don't fade Fridays, because a lot of times over the weekend, we're going to see just sort of an emphasized, kind of an exaggerated open based upon those closing, 20, 30 minutes of the Friday session. So with that in mind, let's go ahead and jump into the questions. I see them coming in. All right, cool. Kicking it off there with Tim. Hey there, Tim. How you doing? All right, let me get these charts out of the way of the questions. All right, there we go. Okay, so when trading a smaller account, sure, and sticking with risk management, would I recommend multiple trades across trigger levels or taking one trade on different symbols? So Tim, ideally, when I set up trades for the mastery or for the futures room or for the options room or wherever I am, but the bulk of my trades are shared in the mastery, the sector secrets mastery. What I try to think about is having no more than about 9 open positions at one time. Sometimes we don't get that many, and 9 would be 9 positions that have not hit their first target yet. So that's something that I kind of keep in the back of my mind. And I don't want traders, unless a trade is pricey enough to be unaffordable, I don't want traders cherry picking from the alerts, ideally, because I don't know which one's going to work. I don't know which one's going to follow through. I don't know which one's going to be a mega trend in our favor. I do not know. So not knowing, there's no way I can say, well, this is the high probability trade and this is the low probability. We don't play that game, because that's not a game we can play, because we don't tell the future. So my thing is, if you can take every alert and maybe grab a moderate, maybe grab a conservative, if you can, if we get down to those levels, see if you can't take a piece of every one of them, just a smaller piece, so that you're not cherry picking and presuming, this is the one that's going to work, because I don't know if that's the case. So I try to take a piece of lots of different ideas. So I hopefully that helps. But you take one trade on it. So yeah, I think if I understand your question, Tim, yeah, if you want to pick a trigger from each and just wait for that affordability to reach the zone that you're comfortable with, that's absolutely fine. Yes, 100%. I'm totally fine with that. Again, the main idea is, am I building a book of trades? Am I building my trades in such a way that I am asking myself, not ever, how much can I win if I'm right? Everything should be geared towards just assuming you're going to lose. Just assume you're going to lose. And when you build a trade with risk being the primary expectation, I'm not saying being a downer and being a pessimist, but I'm just saying the only thing that we can control is risk. I cannot control where the market's going to go in my favor. But I can say when prices reach a certain level, I'm done and I'm going to get out. So those are things that I think about. What are my thoughts on VZ? Verizon, you can take a look at a lot of the telecommunication names right now. T is your best uptrend. by a landslide. Mark, T is your best uptrend. I have no interest in Verizon, really. Telecommunications, IYZ, and some of the stocks within the telecommunications are moving higher. IYZ itself looks a lot like XLC, but there are a few names you'll notice that are moving higher. VZ's not doing a good job either way. The closer we get to the 200, maybe we can play a fade of that, but for the most part, we're seeing a lot of strength, and T would be the strongest of them. Next up, can we take a look at SHEL? Sure. Nice uptrend, pulling back. That kind of gap, Ronaldo, I like to give it a moment to breathe, because that's a significant move. We don't know if we're going to do something like this, because that was a gap too, right? We're going to kind of move sideways, or if we're going to keep heading lower, right? We do not know. But when we see an exaggerated move of some sort, a large gap or price movement that exceeds the historical price movement range for that symbol, it makes sense to tap the brakes. And not that I want to be a short seller, but let's just see where price action goes Monday. Is it an inside day? Is it a minor low, perhaps? And I would say minorly the same thing with BKR. The thing, though, let me show you something here, gang. And it doesn't matter if you're interested, everyone, in SHEL or BKR. All I'm saying is go down to the bottom of the chart, take a look at the multi-trend. This is a far more established uptrend. Take a look at BKR. It's a little bit more wishy-washy. It's bullish for sure, but if we can get the more stable uptrends, we're going to be better off with that. Okay, so great question. All right, how do I like Halliburton? So Halliburton, remember who it's a part of. Halliburton's a part of the OIH. So Halliburton is a part of this. It's a part, and Halliburton, Schlumberger are your two heaviest weighted stocks within OIH. So Halliburton is probably the most affordable way into OIH, more affordable than Schlumberger in terms, but not much more, and definitely more affordable than OIH. So what I would say is, yeah, I'm fine with the pullback buy. Oil stocks are doing very, very well. I would focus a little bit more on the FCG and XOP names, but I do like the OIH and the XLE names as well, Julian. Yeah, absolutely. When do I use Fibonacci? That's a huge question, Mr. Walker. Definitely one that's going to, sort of be much larger than the conversation we have time for here in our Sunday show. But the how is essentially looking for retracements, preferably within trends or preferably within significant rallies or declines. That's the how. And the when is when I get those. So if let's use Halliburton, right? So if I were to grab a minor low to minor high, that's how I would draw Fibonacci. Well, now what is this last major move? That's what I was taught. This is your low, that's your high. Both of these, this is actually a minor low, that's a minor high. So I like looking for the minor high, minor low pattern. So here to here. The next thing is it a significant rally? Yes. It has to be, I know some people ask, if it's less than 3 candles, not interested. So it's got to be greater than 3. The other thing is it unretraced? I don't want to see a lot of this on the way up because I think that reduces the effectiveness of the Fibonacci levels. And so it's the most recent significant rally or decline. And for me, one of the easiest ways to start finding those would be looking at the support of a minor low and the resistance of a minor high. So that's a quick breakdown of what I look at for Fibonacci. Probably the most important thing is just to reiterate, Fibonacci is support and resistance. At the end of the day, it is simply support and resistance. And that being the case, remember, there's lots of ways to find support and resistance. Darvis is one of them. The wave is another one. Propulsion is another one. But I am a fan of Fibonacci. It's just a little bit subjective until you learn and put a process around it, that's a glimpse into my process. So thanks for the question. All right, next up, Qs, heading lower. We've been, for some time, gang, I've been basically, on Tuesdays and Thursdays, I do the free video for the Futures Room over at the Simpler Trading YouTube channel. And for the last few Tuesdays and Thursdays, I've had two big themes. One, please don't think this is the bottom. Respect the trend that was. And that's really, again, Charles Dow 101, give the trend that preceded the chop the benefit of the doubt. The most likely movement is going to be in the favor of the trend that preceded the chop. In other words, please don't buy bonds. Please don't buy equities as a general rule in terms of S&P, NASDAQ, Dow, Russell. And if you're not comfortable with what we're dealing with, especially when we're in this narrow range, the second big theme we've been talking about for weeks now is shorten the time frame. Think about just trading setups that are on 5-minute time frames that are good for 2-hour blocks. You're looking for these 2-hour windows of movement, be a day trader. And those have been the two big themes. So, Qs, we've been waiting for that movement higher. We were never looking at the market to move to the upside, because if we respect the trend that was it. So this is really just waiting for that continuation. And that break happened not on Friday. That break happened on Thursday, on June 9. On June 9. So QQQ is the same conversation. SPY is the same conversation for sure. All right. AEM is on the radar. Okay. An entry about 55. I got to tell you, I don't love it, my friend. And here's why. I like the structure. I can see exactly what you've lined up here. 200. Love it. And downtrend, like that too. See that there. But this candle right there, that we need to give that thing a minute. I want to see a minor low inside day, or we can just line up the resistance of the Darvis that's waiting right there, right in there. So that might be worth waiting for, this area here. What I would say is, and I'm sure you've already done this, Alan, but take a look at AEM within the perspective of, what are you hanging out with AEM? When I go and do a reverse search on AEM and I ask myself, all right, who are your friends? AEM, who are you hanging out with? You're going to find, I'm looking right now, GDX. I'm thinking GDX is probably the one that, so GDX. Now, I definitely want to know if this, from a relative performance standpoint, is going to be a name that I do want to focus on within the group that it's in. So then I would want to rebuild out my multi-chart, do the relative performance. And here's the thing, my friend, look at all the red. Look at all the red. How about GDX, right? Because if we have a number of these names on our radar, NEM, gold, WPM, look at all the red. AEM is the only one that's yellow. So frankly, my friend, that's actually not going to win, right? But I love where you're looking. Which is to say, this is a downtrend, and the tide is red over red. What's not to like about that? So now I'm a little bit more fond of GDX. Yeah, I'm a little bit more fond of GDX in that regard. So I don't know that I would go stock picking here. If I can grab the tide, I would definitely consider that in lieu of a yellow, blue candle rally and fading that. Although that's perfectly fine too. If the tide's going to go out and you like that name and that's a setup that's really got your attention, but I just want to make sure you're looking at some of the others there. So good eye, Alan. Really good eye. Awesome corner of the market where we have a good degree of clarity. And then, for me personally, this lines up with the fact that I'm looking for gold to move lower. All right, next up, lumber is one of the worst performing futures contracts this past quarter. Yes, it's very illiquid. It's very illiquid. Would I consider trading it? I do not recommend trading lumber futures. No, I do not recommend new futures traders, even seasoned ones. I don't trade lumber that often. No, I do not recommend trading lumber. One of my main reasons that I won't trade a particular symbol, doesn't matter if it's an ETF stock or futures contract, is if there's not sufficient liquidity at the open interest. Volume I'm not as concerned about because volume is cumulative. The volume at 9:30 or 9:40 is not going to be indicative of what we'll see at 10:30 or 10:40, right? So that accumulates during the day. It's the open interest that I'll look at. And open interest on a number of futures contracts like lumber are very low. And so I usually say no. That's a big no. That's usually a pass for me. So thank you for the question. As far as pound goes, whether that's pound US or if we're looking at the 6B, it's doing pretty much what we've been talking about 6E doing. So I like, we've been talking about currencies on and off for some time, Les. And in the macro market deep dives, we've touched on them a few times a month. 6E, 6B, 6J, euro, pound, yen. Those are all in conditions where they are shortable. And those are indirectly bullish plays on the dollar. So thanks for the question. DVN. So DVN looks to be really one of many stocks that are in let me show you right here, the oil narrative that I do like very, very much. So if I take a look at XOP, crack that open. If I take a look at XLE, crack that open. We take a look at FCG, crack that open. There are uptrends in this market. They're mostly though going to be related to the oil, gasoline, and natural gas commodities heading higher. So XOP, XLE, OIH, FCG, these all look fantastic. So kind of related to Alan's question on AEM and GDX. There's so much here that looks so great, right? Unless an individual name comes back down to a level that we can do something with and it's liquid, right? And it's liquid. If I can get a shot at XLE, right? If I can get a shot at XLE, I'll take it. If not, I've got to wait for these individual names to pull back, a number of which last week we did get into. So I do like Devon for a buy the dip. 21 propulsion, I do like it. I think what's going to be tricky though, because so many of these are heading higher. Quite a few of them are retracing into zones that we could buy. CVX is, Oxy is, DBN is. When you have that many, go smaller size on the budgeting because you might end up with multiple names in this corner of the market. Or if XLE pulls back and you don't have a position in these stocks right now, go with XLE. It's just going to give you a better bang for your buck. All right. All right. So that is pound US, euro, stick with the long dollar less, and DVN, stick with long oil stocks, natural gas stocks, gasoline, RBOB gasoline stocks. Yep. Stick with that side of the market. Okay, next up is, hang on, gang, CTRA, sure. And by the way, that breakdown of euro, pound, yen, gang, I'm still very much a dollar bull. I've been saying for a while, if we are still going to see rate hikes, please don't bet against the US dollar. So that short euro, short pound, short yen. The other side of that coin, by the way, that's long dollar. All right, next up is CTRA. All my cards on the table. We've been getting in and out of this one. I like this one a lot. It's been on the radar. The problem with CTRA right now, I like it, Javier, but the last time I checked, CTR was kind of illiquid at strikes that I normally would be interested in. It was relatively illiquid. So probably a no-go on that. Not because I do not like the name. I like the name very much. The issue is the liquidity at the strikes that I would like to buy. That's the problem right now. So if that changes, CTRA might come back, but right now, not so much. Alex asked, what about put call ratio? Can we wait for a bounce up? Alex, I will tell you, and I appreciate the question. So I definitely don't want to sound like I'm dismissing it. I don't follow put call ratio. Put call ratio is a lousy indicator of specific timing. And you probably noticed in just watching it, Alex, it gives you an environment. Maybe we're overbought, maybe we're oversold, but I don't, and it's not even put call ratio, Alex. I don't follow any internals at all. The only one that I think could be sort of viewed as an internal is the VIX. I look at VIX futures. I don't even look at the VIX or the VIXI or what. I don't VIX futures. I do not use internals. So that's probably, in fairness, a question I have no business answering because I don't actually use them at all. I think market internals are unbelievably overrated. And also, and you might think, oh my gosh, Rog, total heretic. Yes, but I have a why. Market internals are not weighted the way in which the markets themselves are weighted. So that the Dow is a high concentration weighted market. The NASDAQ is that way. The S&P is that way. All the stocks are not weighted equally. And you have maybe 5 to 6 stocks in the S&P that make up nearly 20% of the weighting of the S&P. So that's what high concentration weighted means. Market internals are not built that way. So I don't look at something that isn't really a true representation of the composition of these indices. So that's why I don't use it. I do appreciate it, though. I do appreciate it. The question, I just think there's better ways to look at movement. And I'm certainly not waiting for a bounce up, my friend. No, not at all. All right. Next up, Steve asks, in my ultimate day trading class, let's take a look at some intraday charts. Well, we're bringing this question up from Steve. So that was a couple. Yeah, I've done, this will be the third day trading class that I have done. Every time we've touched on, each year, what has been working that year, and really focusing on the tools that I use. And every year, it's not that I abandon other tools, right? I still have V profile, V score, anchored VWAPs. I have them on my charts. I absolutely do. A lot of times people say, Rog, I'm looking at your charts right now on the screen, and they're just not showing the things that I've seen you use in the past. Gang, let's see if this will come up. There we go. That's my desk. That is not how clean it is. Negative. That was right after we put it back together again. That's a dining room table and 8 really big monitors. I have a lot of monitors on my desktop here that I'm sitting in front of talking with you all. So yes, I've got my VWAPs and V scores, my V profiles, propulsion dots, all those things on other screens. I'm always watching them. Yeah, and I still watch those, Steve, because volume is never, ever going to be unimportant. We even talk about volume ledges and the volume profile that you can see over on TradingView.com. So if I've taught you all something, rest assured, on that dining room table desk of mine, you will see one of those charts is going to have things, because if I've spent the time to automate them and I've spent the time to teach them, they don't leave my screen. They just may not be on my main screen. You know what I mean? They're not going to leave my screens in terms of what I'm looking at. So it seems I'm more focused on HPMR. You know, it's funny, Steve, of all the tools, the two oldest tools on my screen are the V-score, which I developed in late 2008 for myself, just a standard deviation of the VWAP. And the other one is the HPMR. And the HPMR, actually, funny enough, dates back to 2010. So I wrote a book in 2010 called 4X on 5. And in that book, I started introducing the concept of these things called power stats. And power stats were historical volatility data that I was really back in 2010, just really 2009, 2010, just starting to play with this concept of having historical volatility, which was really very much different than anything else that I had gotten a chance to play around with. It was incredible data. And in those subsequent years, by 2013, 2014, we had really codified everything and had a spreadsheet and had a process by which we started to project the volatility and time-based highs and lows. And those eventually simply became the code of the HPMRs. But this process started in 2010, and it was really based on the data, this historical volatility data, day to day, hour to hour. That's how granular we had the data. And then eventually, look, once you've got the actual arithmetic sorted out, the first place it went to was a spreadsheet. And then eventually the spreadsheet just was evolved into an indicator. That's it. So this particular indicator, holy cow, I guess it's almost, 2010 to now. It gives you an idea of how long this has been a process. And so I've never not been focused on HPMR, Steve. It's just that now I've got more data. I've got more time to be able to really fine tune and put the indicator on the screen. We can do it for ETFs and indices, futures, you name it. So that's the first answer. This is not a new tool. It's just now, we're actually gotten to the point where we can put it on toss, multiple symbols, not break toss. And I've got the data that works for it. And that's what's powering it. The other part of it is we're in chop, my friend. When the markets are trending like we saw in 2020, 2021, it's really different to be a day trader in that environment. You're really surfing different trends, right? But when the markets get choppy, heck, proof's in the pudding. Last 2 Fridays, I've just put the HPMRs in the screen and said, you know what? We're gonna run them through the most difficult testing we can. Here comes non-farm payroll. HPMRs, do your thing. We had a great short Friday before last. CPI, we did not touch the volatility ranges, but the process said, hey, stay short. That's it, right? And so that was that. Here we are on the open, right? Opens are pretty difficult. We have a gap down. We have definitely some drama playing out on the open, and look at where our support kicked in. So that's the way right now I'm emphasizing. So it's almost as if we've got this big group of tools, and most of my tools have been with me for years and years. And when I teach a class, I teach what in the current environment and the foreseeable environment is going to work best. And so the HPMRs are definitely not new. It's just that right now, especially in CHOP, they're very necessary. And now we can pull them on all sorts of symbols really easily. And that's what I'm really excited about. Okay. So I hope that that makes sense. And I appreciate the question. Like I said, if you're curious about this, volatility, I've never seen anything like that. What is that? If you've never seen it, it makes sense because it's something I created. And so again, taking the data from historical volatility, understanding how many points a market can move on a specific day or a specific time of day, that's really where that comes from. So that's really where, going forward, as long as we're in this choppy mess, I'm going to continue to ask myself, all right, what can volatility levels tell me about the state of volatility? Is it within normal parameters or is it extreme? On the Dow and on the Nas, they're showing me they're extreme right now. This is something we call sandwiching. Leave it alone. Yes, it's coming off support, so that's fine. But this warning says, hey, we've got a pretty volatile market on our hands based on what we usually see from 6 to 7 p.m. Sunday and what we're actually getting. So these are not just warnings of where dynamic support and resistance can be within the context of volatility and time, but then also it sort of warns you when we're wandering away from sort of normal price action. And by the way, that's where a lot of us get chopped up, when things are not acting like they usually do. But normally we don't have a measuring stick for that. And that's what this becomes. So I appreciate the question, Steve. Did 34 minutes already go by? Holy cow. Well, that went quick, gang. As always, thank you so much for being here for our show. I really appreciate it. And I will see you all for Charts and Coffee tomorrow. Be good to each other. Enjoy the rest of your weekend. And I'll see you at 9 a.m. right back here at the Simple Trading YouTube channel. Be good to each other.